All right, traders, welcome to another episode of the pre-morning show, which at some point I've got to give an official name to. Welcome. Great to see you all. Happy Thursday, gang. All right, so let's get after it. Let's take a look at what we've got going on. By the way, you'll see on the screen, I don't like email. I don't like long emails either, but a lot of you know that I will text you back. This comes to my phone. It's pretty cool. It's a service called Community. Gives that text number comes right to my phone. Send me your requests for shows, topics, questions you might have about the market. Just text it to me, and I'm quick. I'm pretty quick to get back to everybody. So thanks for those of you that have hit me up with questions and inquiry about the kind of trading that I'm doing and what we're doing here in the morning. I appreciate it. So as always, thanks for coming, and we're live until about 9:20, and then I'll head over into the Simpler Futures room, and we'll take a look at what kind of day trades we have going on today. So let's talk about some short-term trades, because yesterday we saw this rip higher, and one of the things that I got a lot of questions about was, well, Rob, what was that? Does the market really not care that we're probably going to go into this prolonged election uncertainty? And, gang, I've said this for a long time. When it comes to trading, you really want to just sort of be agnostic. And that means just accepting, at the end of the day, the market really doesn't care who's in the White House. We can talk about it. I think a lot of people feel very passionate about it. It's not a market investing question. What matters is what the Federal Reserve is going to do. What matters is what Federal Reserve is going to do with balance sheet going forward, with rates going forward. And at the end of the day, it just doesn't matter. The market can rally on either party. The parties will tell us otherwise, but the market can rally on either party. And after you've done this for a few decades, you'll realize it just really doesn't matter. So why is the market going up? The market's going up for a couple of reasons. Number one, you guys might remember that I said there were three places that I was pre-positioned in before the election, and only three. All right, and only three. And hey, good morning, Deb, Matt. For goodness sake, I love that. Paul, great to see great to see a few new names and our regulars. Love it. Love it. And for those of you that are brand new, welcome to my office. This is where I work and spend a inordinate amount of my day, but it is my bat cave, and I'm very grateful to be able to do this every single day. It's pretty awesome. All right, so the gold trade that we talked about, staying long gold, working beautifully. That was something that I felt would be fine to be pre-positioned in before the election. In other words, gold isn't really going to care who's in the White House. We shouldn't, as traders, really care who's in the White House. I'm not talking about citizens. I'm not talking about, what we're doing in the rest of our life, but as traders. I tell this story often. It was in a great interview. If you have the chance to check it out, I believe it's on YouTube. You know what? I'm going to put it right on the screen because it's a really good interview with one of the absolute greats in trading, and that is that's Stan Druckenmiller. Okay, and if you go on YouTube, you don't have to be a subscriber to the site that interviewed him. It's actually a Real Vision interview with Stanley Druckenmiller. You'll find it. You can probably find it on YouTube. I forget how long it is, but just search it on YouTube and you'll find it. And one of the things he talked about in that interview, and he does not do interviews very often, and I highly recommend you guys check that out. One of the things that he talked about is during the 2016 election, how many of his look, he's not hanging around with, traders who are just learning how to do this. He's hanging out with other big time traders, people you would think would know better. And he said one of the things that many of his peers did is they got very emotional about 2016. They got very emotional about the election. They mismanaged their books and they lost money, or they didn't make as much as they could have. So I will tell you, after 32 years, the market really doesn't care who's in the White House. What the market does care about is how soon can we get back to talking about when the Federal Reserve is going to plug what is very likely going to be $2-ish trillion of stimulus. I shouldn't say stimulus, but yeah, that's really what it is. When we're going to keep expanding well, it's not the Fed, Congress, right? The Fed's telling Congress, you've got to do this. Once you put that money in the system, we can start to expand our balance sheet again. In other words, we can start buying those treasury bonds. You need to stimulate the economy. We can't drive rates any lower than they are, but we do need bonds to buy. So I just mentioned that because it's so easy to get caught up in, look, the media wants us to think that we all hate each other. The media wants us to think that, everything is awful because the media knows, just like any fear-mongering television, that the lizard brain is going to be absolutely captivated by that narrative, right? Why? And it doesn't matter if it's political or if it's financial. Why do markets in turmoil specials get such constant rotation? Because it grabs the lizard brain, right? It grabs it and says, okay, this is something you need to be afraid of. The T-Rex is coming to eat you, whatever it is. So let's go into the charts here. Let me minimize me. Boom. All right. So we have a distribution market. Take a look at the S&P here. This is really interesting. We have a distribution market, and that means this market's in chop. Chop should still respect the trend that preceded it. If you get nothing from your time with me, please know, and let's see, I feel the same. Hey there, Artemis, Sean, Sadat. Good to see you all. Alex asks, do you think we'll continue to see the wide margin? Yes. Well, wide. What's wide, right? What's the measuring stick for wide, Alex? And I know that a lot of us are curious about what that is. Distribution, which to your point is chop, is defined by the support and resistance levels that it's so far been contained within. Do we see those levels here? I use something called Darvis 2.0, which is just sort of a modernized reimagining of Nicholas Darvis's original tool that he developed, or original process that he developed back in the 60s, actually late 50s, really. So we just modernized this so it's not quite a 52-week breakout high type approach, but rather an approach that capitalizes on the candle count and minor highs and minor low patterns. And that's what you've got there with the yellow and those purple lines in the chart. That's our range. That's our range right now. But remember this, and let me get my drawing tool and I'll show you what I mean. So keep this in mind. And this is really important because this is a point that really did begin with Charles Dow. It seems to be forgotten. This is the trend that preceded this, the chop. What a lot of traders inaccurately do is they assume if a market's not in an uptrend, then surely it must now be in a downtrend. And just so that I don't mince words, realize that is epically stupid. I've had too much coffee this morning, maybe, but it is epically stupid to reduce the market into, well, it's really in an uptrend or it's in a downtrend. That's what most market participants do. Be happy about that. Look, the more ill-informed your opponent is, meaning other traders out in the marketplace, the easier your life is going to be. So if those traders are tripping over themselves to get short, you know what I'm doing? I'm either buying calls that are inexpensive into that weakness, or I'm selling premium on puts for those folks who want to just trip over themselves to get short the market, because if it's not going up, then surely it's going down. Charles Dow, 140 years ago, the wisdom of Dow has stood the test of time and will forever, because it's a reflection of human behavior, not getting into technicals or fundamentals or none of that stuff. What is the characteristic of chop? To Alex's point, it's uncertainty. Are we in an uncertain time? I think we're not uncertain about whether or not we think the market's going to keep going up, or that we're going to get more stimulus, or that we're going to see eventually COVID numbers drop, or we're eventually going to see a vaccine. Regardless about my opinion of any of those things, those three are the big points that the market's moving on right now. With that said, respect the trend that was. That's it. We can talk about all the other things about the factors, the ongoing election uncertainty, although that's becoming less and less uncertain. Why is the market rallying? A, it doesn't care who's in the White House, and B, give us our darn stimulus. Let's get on with it. Okay? Have we forgot about Santa rallies? Have we forgot about these things? Yes, there's a lot of awful data out there, jobs wise, and a lot of uncertainty. But gang, this market and this Federal Reserve has ignored and sort of massaged a contracting economy since the summer of 2018. You can look at GDP numbers and see the contraction, the peak of the economy in August, I believe it was, Q3, I believe it was. Early Q3 or really late Q2. But August, I believe, is when it was. We have been talking about a stock market that's moving higher, but believe me, when you look at the inflation targets and when you look at the GDP, gosh, don't believe me, go to the BLS, Bureau of Labor Statistics, and you can see all this data, CPI data. You can look at GDP data at Forex Factory Trading Economics. So we really don't care if the economy is contracting or not, because it has been. This is not a new narrative. So when people say, but the data is so poor, it has been poor for a while. It's perception, gang. It's always perception. Macro in 2018, 2017 was amazing. It started to lose its footing in 2019 because the Federal Reserve, which is the most important macroeconomic factor affecting all other macroeconomics, remember, is really four pillars. News is not macro. Earnings really aren't macro. What are macro? Monetary policy, money supply, GDP, and inflation. Now, some of the other sort of sub data, right? Data that would fall underneath those big columns, those big categories, will affect those over time. But those are the four big points of macro. So don't confuse macroeconomic conversations about an ongoing trade war, which was done for a while, or what the earnings are, trends in earnings. That's not really macro. It might affect macro. Macro will certainly affect them. But those are the four big pillars of macro. And the market's utterly been ignoring that. So if you look at people who hang their hat on macroeconomic study, they've gotten their you-know-what's handed to them because they've refused to accept the fact that data can be awful, the Fed can continue to print, and we can be looking at an uncertain election and COVID numbers and vaccine uncertainties, and the market wants to rally. So when people say it's a really dumb rally, remember, it doesn't matter if it's dumb or smart. It's perception. So I don't want to go off on too much of a tangent, although too late I already did. But at the end of the day, the expectations are things are going to be moving just fine. But we're probably, to Alex's point, and you can see here with the yellow wave on this chart, this is the ES. Let's just jump on over to the YM. With the yellow wave on this chart, you can see that this is chop. So the closer we get to the top of the range, I don't want to get short, but I do want to make sure that if I've sold calls, which I have, I don't care. I'll let them expire worthless. Gladly. I've collected my credit and I just want them to expire worthless. If I've bought calls, which I also have, then I will want to take profit on those calls. As for example, DIA calls get close to 28,800 on the YM. My triggers for my options on the futures are going to be using the futures prices, but the ETF options as an entry. Sounds a little weird, but it makes perfect sense when you think about the influence that the futures have over the ETF. Now, ETFs are becoming more and more relevant, and they're becoming more and more important. And so there might be a time where we can just look at the DIA and build the trade. But the reason I like to look at the YM, even if we get to that point where you say, Rog, we could just look at the DIA to build a Dow ETF options trade. Remember that the Dow ETF options are only going to trade when the DIA ETF is trading, 9:30 to 4. It's a global market now, gang. So what I like to do is look at that more global 22 and change hour contract, the YM, to make my decisions about what the DIA is going to do. By the way, tonight, going down tonight, we have the last of the two webinars. These are the free webinars that I do before we go into a class. The last webinar is tonight at 8 p.m. Eastern, 7 Central. And we're going to go over some of the symbols that I'm talking about, why I'm long IYT, why I'm long DIA, what individual stocks are we looking at, and the underlying market trends and the way we use options in this environment specifically, because the elasticity of support and resistance, when I say elasticity, think of it giving like I won't say like a trampoline, but it's just mushy. These are soft support and resistance levels. They're not solid, they're soft. They'll give. Distribution markets have more volatility. More volatility lends to softer resistance and softer support. In other words, they're a little bit more unpredictable. So what we like to do in order to have the staying power to deal with that elasticity, with that mush, if you will, is we play the options. We play the options and options in such a way that, yes, they're going to be a little bit more sedate than, say, buying the underlying IYT or buying the underlying YM. But remember that it gives us staying power to not get shaken loose out of our directional bullish bias trade when the markets get a little bit more unpredictable, when they start to get a little bit more volatile, which on an election week, we would presume would be the point, would be the case. I still like the SMH very much. I still like CLOU very much. I still like the shorts in the dollar very much. We are rallying in the dollar a bit, but I've been telling folks, when we get those strength moves in the dollar, look for opportunities to sell dollar against the Canadian dollar, New Zealand dollar, even British pound and euro. And you can see today, right back on track. And we're coming off the oversold lows in the Canadian dollar, which means the dollar itself is at a high. Resistance might be a little mushy, right? The Canadian dollar is at the lows. We buy that Canadian dollar, short the US dollar, which is getting a little toppy. We take advantage of the move. So those are the things that I really like. IYT XLU, that's just a great play regardless of who's in the White House. Now remember, if we see flow into tech, if we see that high beta, high Momo trade start to pick up again, XLU, IYT are not by comparison going to look as sexy. So we're going to see a little bit of weakness in those, but they have been stable. So when the volatility hits the market and the NASDAQ gets Donkey Konged and the S&P gets shook, we notice that IYT, XLU, especially XLU, they hold their own, right? It's not about finding something that's going to move higher parabolically. We're not looking for that. We're looking for the stability. And that just brings me to a lot of traders live on this very wild pendulum. And what I mean by that is they want these big gains, but then what they realize is it's a pendulum game. Risk and reward is a pendulum. So if you're looking at these really hot, big gains, when it goes the other way, you're going to be looking at, relatively speaking, the same kind of losses. The idea that the pendulum is just going to swing a little bit like this on a loss, but way up here on a win doesn't exist. That's why advice like let your winners run and cut your losers short is just so deceptive and downright cruel, because the bottom line we're all seeking is, well, how the heck do you do that? You do that with more of how many baseball fans out there? Cal Ripken. I'm a child of that part. I grew up in that part of the world, Virginia, went to a lot of Orioles games. My cousins lived in Towson, Maryland. So a lot of Orioles games growing up, and loved Cal Ripken. Like that, well, I won't go into baseball, I'll go into a whole other tangent, but Cal Ripken got on base, right? You guys remember Moneyball? Great movie, entertaining movie, amazing book. We want to be Moneyball traders. We want to get on base, And I'm a big advocate of that type of approach. Am I looking for home runs? I'm really not. I'm not looking for that at all. So remember, if you're looking for those parabolic moves, if you're looking to take advantage of those very volatile parabolic moves higher, remember that, what happens when a DraftKings or a Tesla or even a parabolic move in the broader averages pulls back? They tend to pull back pretty violently. Take a look at silver over the past few weeks. So remember, that pendulum, generally speaking, does move that way. You want a steady, as we like to say here in my office, our favorite uptrend is our P&L. A nice steady P&L. I don't want to see these dramatic, 61.8% retracements on my P&L curve. I want to see I don't mind flat P&Ls. I don't mind a little bit of a low, right? But I don't want to see these major retracements. And that's what shakes up a lot of traders and prevents them from being excellent longer term. Anyway, I'm still in cash mode. As long as the t-shirt's on, I'm in cash mode. And I'm not going to be doing a whole heck of a lot this morning, other than probably a little bit of intraday day trading this first 2 hours of the day. And I'm waiting to deploy some capital longer term as soon as we can get a little bit more stability on the election picture, which I think is almost there. Looks like, who knows, but it looks like we're going to have a victory for Biden. Again, the market knows what we know, and it doesn't care one bit. Get us to that $2 trillion stimulus package. Get us to the bond, to the Fed supporting the market, increasing the balance sheet. That's all the market cares about, gang. You know, that's something Stan Druckenmiller talked about in that interview. So I look forward to seeing you guys tonight, 8 p.m. All right. If you like this kind of stuff, you're going to love the webinar tonight. I'll see you tomorrow. I got to get back to the futures room. So as always, thank you for your time. If you have questions, if you have requests, you can leave them here on, I think we're broadcasting on YouTube, right? YouTube, or you can just hit me up on, there we go. You can hit me up here and, topics, whatever. Let me know. All right, gang, have a great one. I'll see you tomorrow.